It's the South Carolina Good Life Podcast with your host, SC Realtors CEO, Nick Kremitis.
Thanks for tuning in to another edition of the South Carolina Realtor Good Life Podcast. I'm glad you're able to join us today. We have a very special guest, Dr. Joseph Von Nessen, to provide us with the latest economic update on where the housing industry is in South Carolina now that we're in the middle of 2021 and what we may be looking forward to as we approach the new year, 2022. This information is critically important, I think, as we try to gauge our business as we go forward. I know one of the questions I get asked repeatedly lately is, when is the market going to turn? When is the market going to crash? Are we in a bubble? And I think what you'll see from the economic data is that we have a continued period of growth ahead of us. So without further ado, I'm going to turn over this episode to our special guest, economist, Dr. Joseph Von Nessen.
It's great to virtually see everyone today and certainly hope that everyone is doing well. All sorts of things are happening, and the market is changing very rapidly, as we all know, here in the summer of 2021. So we're going to be spending some time over the next few minutes this afternoon talking about the changes that we've seen this year, where we are in July of 2021, and where we are headed for the second half of the year. And before we really get started with the market update, I want to just reinforce this link below to give you an opportunity to click on it and download the full study. And the reason I reference this is because I'm going to be calling out several of the graphics and metrics that are explicitly cited in the report several times this afternoon. So this will just give you an opportunity to reference those directly if you have additional questions regarding any of the specific metrics. So again, screaltors.org/market update. The full report is there right now, available for you to go ahead and download. So with that, let's go ahead and dive right in. A lot of information to cover, and it really starts with an assessment of how South Carolina is doing. Really, the most important factor here is to get an assessment of where we are in South Carolina in July of 2021. How is our economic recovery progressing? And again, we'll talk also about where we are headed going forward. But first of all, if we look back in terms of how South Carolina has been doing overall, the short answer is that we've seen a fairly strong recovery so far from the recession that took place in the early part of 2020. And one way we can see a direct representation of this is to just look at South Carolina employment trends over time. And this graph here tracks total South Carolina employment. These values are actually in thousands. But this tracks employment changes in South Carolina going back to January of 2020. And so you can very clearly see the major drop-off in employment in South Carolina between February and April of 2020. We lost about 14% of our total workforce, or about 308,000 jobs. So a significant drop-off just during that 60-day period. But that was immediately followed then by a recovery that we are still in as of July 2021. And you can see here as well that recovery has been fairly steady over time. And it turns out in the 14 months that we have data on now since April of 2020, since the economy began to reopen and we began to see recovery, in that 14-month period, we've seen positive employment growth in South Carolina in 12 of those 14 months. So again, the vast majority of time, we've seen a fairly steady recovery rate. But a bulk of those employment gains did come during the summer months and early fall months of 2020, what we call a V-shaped recovery pattern. So as the economy was opening up, we saw a significant increase in employment levels. And even though employment is still recovering, we're still seeing improvement. We're not quite seeing it at the pace that we had been seeing it during this time last year, essentially. And we can actually put some lines on this graph as well to just give you a more direct representation here of what that looks like. So you can see how the slope and the arrow changes. It just gets a bit flatter and flatter. So you can see as we go from basically the spring and summer months to the fall and to 2021. So steady employment recovery in South Carolina, but at the same time, not as many month-to-month gains as we were seeing last year. Now, if we aggregate this and put it all together in terms of the gains that we've seen over the last year, you can see here that we're still down about 3.5%, meaning that we've recovered to within about 3.5% of the total employment levels that we were at in February of 2020, just before the pandemic began. And that is, again, a very strong recovery that we have seen so far in South Carolina. These represent very solid numbers. And one way to illustrate that specifically is to just put this in comparison with other regions of the US. Here we can look at South Carolina's cumulative employment growth going back to April of 2020, again, going back to the beginning of the recovery period. And you can see how our growth was most concentrated early on, and then it has somewhat leveled out. Green represents South Carolina here. You can see the black line, which represents the United States. And then we can also compare South Carolina to other southeastern states and to the southeastern region more generally. Here we've graphed Georgia and North Carolina, our border states, of course. And you can see that in each case, South Carolina has outpaced these other regions in the United States in terms of overall employment recovery. So South Carolina has done very well. And especially when we compare the US trends to South Carolina's trends during the early part of the recovery, that's where we see the biggest gains that South Carolina made. So the biggest difference between the green line here and the black line. And so the question is why? Why did we see so much of a difference early on? And the answer to that largely comes down to the nature of the targeted shutdowns that South Carolina experienced relative to many other states. In South Carolina, the shutdown was more targeted, and it was also shorter in duration. And so what that allowed for was businesses to open up faster, which of course led to faster job growth early on, but it also helped to prevent permanent downturns. So the longer a given business is shut down, the less likely it's going to be able to eventually come back to its previous business activity, the previous levels of business activity. So the duration of the shutdown matters as well. So in both cases, South Carolina fared a bit better than the US as a whole. And again, that's why particularly early on, we see strong employment growth in South Carolina relative to the US as a whole, again, during the second half of 2020 especially. Now, if we look at overall the employment gains in South Carolina by sector, we definitely see some disparities when we look at particularly where South Carolina's economy is still struggling, as the job growth is not fully, or the total number of jobs that were lost that have not been regained just yet. The question is, where are those losses still persistent? And where are they placed within the industry sectors within South Carolina? And here we can get a very clear indication of that. It's leisure and hospitality. It is the service sector. And I would suggest to you that this is still the best visual representation of where South Carolina's recovery currently stands, because it illustrates very nicely the dichotomous nature of this recovery, in the sense that if we take away leisure and hospitality and just look at all other sectors in South Carolina, basically they've recovered from an employment perspective. They've either mostly recovered all the employment losses from 2020, or they have more than recovered. They have fully recovered. But the exception to that is leisure and hospitality, where we see leisure and hospitality still down about 13.1% from pre-pandemic levels of employment, whereas all other sectors in South Carolina down just about 2.3%. So very, very different depending on the sectors that we are looking at. More generally, we can get a sense of what these sectors are showing on the whole. So this graph represents both the employment losses as well as the recovery that we've seen by major industry sector. And the major takeaway here is just to look at those percentages at the top of each bar. You can see a breakdown by industry, but this just represents the total level of employment relative to where we were back in February of 2020. So on the left-hand side of your screen, you see South Carolina at 96%. That just means that South Carolina is currently at about 96% of the employment levels that we were at before COVID began. And you can see that varies considerably in some cases across industry sectors, but in general, we are very close, again, within about that 2.3% or so when we look at all industries except for leisure and hospitality, which you can see still has a ways to go. Note especially that industries like construction, for example, and housing, 100% fully recovered, as is trade, transportation, and utilities, this sector here, which basically represents wholesale and retail trade, as well as transportation and warehousing and logistics. So think about all the sectors associated with home delivery of a lot of durable goods, which have seen a significant increase in demand over the last year. So fully recovered employment levels there. Now, even though we've seen employment growth slow down a bit in 2021, that has not translated into a slowdown of the recovery of the US economy as a whole. And we can see that very clearly if we look at a number of different metrics. We can look at GDP growth for starters. You can get a feel for the size and scope of both the recession in 2020, as well as the recovery that we have seen since then. So negative 31.4%. In the second quarter of 2020, followed by a growth of 33.4%. In 2021, we've seen solid growth so far. Most estimates or initial estimates projections. Most initial projections are suggesting that the second quarter of 2021 will see GDP growth of between 8 and 10%. So a very strong second quarter expected, and then we'll likely continue to see steady recovery as we move into the second half of 2021. And the primary reason for this, why we're seeing so much strong growth this year, has to do with consumer spending. And consumer spending overall is about 70% of total GDP. So it is the majority of GDP, and it is the factor that drives GDP more than any other. And you can see if we look at total US consumer spending over the last several years, this goes back to 2015, and just notice that consumer spending overall has steadily ticked upwards at a very constant rate, right? So we've seen growth at a very stable and consistent rate over time. So we superimpose a trend line there historically, and you can see the actual data fit very tightly around that trend line. And then notice, of course, the pullback in 2020, but also that as of 2021, we've fully recovered in terms of levels of consumer spending. So we're back on that historical trend. So again, as we're seeing the economy rebound, that's largely due to restoration of this consumer spending, and that's what's largely driving these great GDP numbers that we've been seeing in recent months. But that also generates somewhat of a puzzle, because one of the other factors that we are currently witnessing right now is a significant labor shortage. And that has resulted from the fact that we've seen increasing employment rates, but the employment growth itself has been slowing down, as we've already looked at, particularly in 2021. So not as many employment gains on a month-to-month basis. That combined with the fact that consumer spending has seen a significant uptick in recent months and has largely been restored to pre-pandemic norms, to the growth rates that we normally expect. And so when you put those pieces together, when you see a significant increase in demand, but you don't see an accompanying increase in employment to satisfy that demand, that generates a labor shortage. And that is definitely what we are seeing across South Carolina. We're seeing it across the US, and we're seeing it across industries. So this is a challenge for the US economy and for South Carolina's economy in the summer of 2021. And so the question is, what is the cause of this current labor shortage? Why aren't we seeing more employment growth given this increase in demand? What's going on? Well, there are several factors that are occurring simultaneously that I want to briefly walk through, because there's several sources for the labor shortage. The first is one that we hear a lot about in the news, and I like to call it reemployment resistance. But it's basically the phenomenon that has occurred as a result of unemployment benefits, and specifically the federal supplement to unemployment benefits that has persisted throughout 2021 up until the end of June for all states. So essentially, over the last year, in addition to state level unemployment benefits, many unemployed individuals have been able to also receive a federal supplement on top of the state level unemployment benefits, which has amounted to a dollar value that in some cases has, from a financial perspective, incentivized individuals not to go back into the labor force. And in South Carolina, that cutoff is actually about $16 an hour. And you can see that the comparisons here to various occupations, particularly in the service sector in South Carolina. But the bottom line here is that if you were earning in South Carolina $16 an hour or less before the pandemic began and were working full time, then up until this summer, up until the end of June, financially speaking, you were actually better off staying on unemployment than you would have been going back to work, because you would have been earning more. And so that creates an incentive or a disincentive from coming back into the labor force. And that's a partial reason why, especially in the service sector, there has been a significant labor shortage throughout the spring and early summer months. Now, as we go into July, in 26 states, including South Carolina, those federal benefits have actually been rescinded. So we do anticipate that more people will begin to come back into the labor force, particularly, again, in those service sectors that are paying at or around $16 an hour. This would not necessarily apply to industries that are paying significantly more than that, because, again, individuals would have earned more in those sectors already. So manufacturing, for example, paying closer to $30 an hour. The federal benefits are not the source of any labor shortage in manufacturing that we're seeing right now, but it is having an effect in the service sector. And this is one significant reason why there is a labor shortage currently. But it's not the only reason. There are several other factors that are driving this labor shortage that we're seeing now as well. Three others that I just want to briefly mention that we don't hear about quite as often. The first is the fact that baby boomers have been retiring at an increased pace over the last year as a result of the pandemic. And so this has also limited the labor force as well, limited the size of the labor force. Baby boomers who have been looking to retire may have been looking for an excuse to retire or are on the verge of retirement. And the pandemic and the change in the work environment may have led them to basically move forward with those retirement plans, or in some cases, they may have been laid off and decided just not to go back to work. But a key factor here, a key element of this story, is not just the baby boomers' retirements because of the pandemic directly. It's also the fact that we saw a very quick stock market recovery, and that's a very key element here, because this makes what we're seeing now very different from what we saw in 2008. Because if you recall, in 2008, we saw a more than 30% decline in the stock market, which took several years to recover from. So if you were a baby boomer in 2008 and you were about to retire, the stock market seeing the significant contraction and not having a quick recovery, in many cases prevented the baby boomers from being able to retire and delayed that retirement for several years until they could get their portfolio back that had been diminished by the financial crisis in 2008 and the stock market declines. This time around, however, things are very different, because we did see the Fed step in immediately. We saw a very rapid stock market recovery. And so baby boomers who had maybe pulled out temporarily, or what they thought might have been temporary, because they saw the stock market recover so fast, they weren't as concerned about their profile. So that was a very important piece of why we saw accelerated baby boomer retirements over the last year. And then finally, two other factors that have contributed to this labor force shortage. One is adults who have been caring for family members. That could be elderly relatives, or it could be children, and particularly in the virtual learning environment where many parents have had to stay home. We anticipate in the fall, as students go back to a more normal learning environment, that is going to help alleviate some of this labor shortage as well, in addition to the federal unemployment benefits expiring. So both of those together will help to resolve some of the labor shortage. And then finally, higher savings rates is another reason that we're seeing a labor shortage right now. Because if we look at the personal savings rate over the last several years, you can see a very clear difference here in this graph, just comparing where we were before 2020 to where we are now. So the personal savings rate was at about 7% historically in the US, and it jumped now to over an average of over 15% over the last year. And why was that the case? It was largely because of the stimulus payments. It was because of the more generous unemployment benefits. that was generating more income for individuals, and individuals were staying at home. So they were saving more of this money. And so as a result, as the economy reopens, many people have more resources and they can live off of their savings for a bit longer before they go back to work. So this is simply slowing down the rate of individuals going back into the labor force. So there are many factors that are at play here. It's not just about the unemployment benefits, although that is one of the factors that we hear most about. And then in terms of data, we can very clearly see this labor shortage if we just look at the job openings rate. There are many ways that we can clearly see what the size of the labor force shortage is. But this is one way to look at the US job openings rate and just to compare what it looks like today to what it looked like the last time we had an unemployment rate at 4.5% in South Carolina, which is the current unemployment rate in South Carolina as of June. The last time unemployment was this low was back in November of 2016, which you can see illustrated here, but a very different level of job openings, given the fact that our unemployment rate is comparable. So just a very striking difference here, a very clear way that we can see visually what this labor force shortage currently looks like in the US and in South Carolina. Okay, so that's where we have been. That is a snapshot of the recovery that we have seen to date, both nationally and what's been happening in South Carolina, and also a snapshot of the causes for the labor shortage, which has been a new development as a result of some of these factors that have developed throughout the last year in the aftermath of the pandemic and in the recovery. But of course, we want to talk specifically about housing as well and how these trends have affected housing markets and what we can expect going forward as we move into the second half of 2021. So how have housing markets responded? What have we seen overall? Well, first of all, as you all know, housing has had a record year in the United States as well as in South Carolina. This is something that we are all, of course, intimately familiar with. And here are a couple of illustrations of that. Where we can see, regardless of the region that we examine, housing sales have seen positive record years over the last 12 months. So we compare on the left side of your screen housing sales for new home sales, for existing home sales, as well as data from the South Carolina Multiple Listing Service. And here we just want to compare what's happening in 2021 with what's been happening or what was happening in 2019, and kind of throw out the spring months of 2020, because obviously that was a major aberration in terms of the brief downturn. So even if we compare where we are today to pre-pandemic norms, right, throwing out the unusual activity of the spring of 2020, clearly we can see that housing demand has been very, very strong and unusually strong in 2021. So double-digit growth rates across the board, regardless of the metric that we see here. And then on the right side of your screen, one of the corollaries to that is a significant increase in median prices overall, both for the US and for South Carolina in particular. Again, we can see historic price increases that have been experienced in most housing markets or many housing markets across the country, and certainly in South Carolina as well. So the big question then is, what has been driving these changes? And is that going to continue going forward? Because we have to understand, first of all, why these increases have occurred before we can then look at whether or not the causal factors are likely to change going forward. So the first reason that we saw such strong housing demand persist over the last year throughout the pandemic and the recovery from the pandemic is that employment levels in South Carolina have remained relatively constant when we look at jobs that are typically higher wage positions. And we can see that here. If we just compare employment levels over time, going all the way back to January of 2020, we can break that down into relatively higher wage and relatively lower wage positions. And you can see that in general, the higher wage positions recovered much, much faster. And it turns out that the potential home buyers overall fit more within the categories of these higher wage positions. And those are people that are more likely to be qualified home buyers. So as a result, we've seen relatively high rates of unemployment in 2020, coupled with relatively high housing demand. Or put another way, the majority of the people who were unemployed in 2020 typically would be in the rental market, not in the home buying market. And that makes a major difference for builders and for the real estate community in terms of potential home buyers and potential customers. So housing demand, the single best predictor for housing demand is always employment growth. And so when we see employment growth that was largely uninterrupted, not completely, of course, but largely uninterrupted in 2020, that led to a preservation of a major source of housing demand that allowed housing markets to continue to do well, despite the fact that we had high unemployment overall in South Carolina and the US. And recall that we talked about leisure and hospitality having the highest level of unemployment and is still the sector of the economy that currently is down in terms of overall employment levels. And the leisure and hospitality sector also tends to employ relatively lower wage workers. So this all ties together when we look at the industry distribution and these overall employment levels by wage categories in South Carolina. Now, a second reason why housing has done so well in the last year is that disposable personal income has been up significantly over historical trends. We can see that here. We go back to 2015. We can see the overall growth rate of disposable personal income on average over time. And because of the stimulus payments, because of unemployment insurance benefits in both cases, that led to an increase in disposable personal income that you can see here. And what does that do? More disposable income provides more resources for Americans to be able to spend on various goods, including housing. And that can help, for example, with renovating a home, or that can assist with a down payment. So when disposable personal income goes up, that will have a major effect on the purchasing power of Americans, and the housing market has benefited from that as well. And then a third reason why we've seen housing persist and do so well in 2020 is because of an effect I like to call the substitution effect. And that has been the result of consumers in 2020 shifting away from spending on services and towards spending on goods, and durable goods in particular. So if we think about two broad categories of consumer spending, one being goods and the other being services, we can think about an equilibrium or a distribution between those two types of goods. And so in 2020, when people weren't traveling, they weren't going out to eat, they weren't going to hotels and outdoor events, they weren't spending on services. So what were they spending that money on? Particularly when they had all this disposable income, they were spending it on durable goods. And housing, of course, is a major durable good. And so we saw this uptick in durable goods spending. Very clear distinction here when we compare on the left side of your screen durable goods with services on the right. A major uptick beginning in 2020 in durable goods above the historical trend, compared to a major pullback in services, very much below historical trends. So that substitution away from services and towards durable goods. And that is a major factor here in what's been happening over the last year. And it also is a major factor in moving in reverse now in 2021. So each of these factors are going to be important to monitor going forward, but particularly these substitution effects and the income effects as well. The fact that the fact that disposable income, we can go back one slide here and just take another look and notice that disposable personal income, even though it had been high for an extended period of time, is now falling back to that historical trend of growth, back closer to that black line. And so that's what we're beginning to see. And so I would suggest to you that the substitution effect especially will be a primary driver of changes in housing demand going forward. We're already seeing a surge in spending on services. And so people are looking to travel. There's a pent-up demand to go out, to spend time with family and friends. And as you can see on the right side of your screen here, basically we're looking at an economic tug of war during the second half of the year, where more and more consumers are really going to be joining this side of spending on services as opposed to durable goods, and moving back to those pre-pandemic norms. And the speed at which they do that is going to greatly impact housing demand, because again, housing is very obviously a durable good. So that is an important component here. So those income and those substitution effects moving now in the opposite direction are very important. And we're already seeing this in terms of the data, in terms of a bit of a pullback in overall demand for housing. So we can look at several different measures of this. So if we look at new single-family home sales, these graphs directly from the report, and we just highlight really the somewhat of a bubble that we have witnessed over the last year. So new single-family homes peaked and are now beginning to come back down closer to pre-pandemic norms. We see this if we look at existing single-family home sales as well. Again, a significant uptick followed by somewhat of a pullback to pre-pandemic norms. And then we're also seeing this in South Carolina as well, looking at the South Carolina multiple listing service and reported sales activity here as well. Now, this is very different. A pullback is very different from a contraction. So I want to be very clear on this point. And what we're looking at is more of a reversion to pre-pandemic norms. So that means a pullback to levels of activity that were more comparable to what we were seeing in 2018 and 2019. We're not talking about a market crash or a major correction or anything catastrophic, certainly. We're talking about a pullback to pre-pandemic norms. So that is what we can anticipate as we continue to move into the second half of the year, especially as these income and substitution effects begin to reverse themselves and move back in the direction of where we were before the pandemic began. So these are both metrics that we need to be following closely, because the speed at which we see that shift is going to influence the speed at which we see housing activity revert back to pre-pandemic levels as well. Now, if we look ahead, there are other factors in addition to these metrics that we need to be vigilant about in terms of the influencing the pace of recovery as we move into the second half of the year. One of the biggest ones, of course, is inflation. This is something that we see most economists talking about, and we see in the news almost daily now. And it is correct to say that inflation is the biggest economic threat to our ongoing economic recovery right now. And we can see that in a couple of different ways. But first of all, we can look at what inflation actually is right now. We can track it. So just to share with you some data on what inflation has looked like over the past decade or so. This goes back to 2010. And there are two primary measures of inflation that you will see quoted often in the news media. We have, first of all, the overall rate of inflation, which encompasses all goods and services in the US economy. And that's the rate at 5.3%, which you see on the right side of your screen there in the blue line. And then there's this measure of inflation, what we call core inflation, which is basically inflation including all goods and services except for food and energy prices, because those are very volatile. And so it is much more difficult to get a reading on what inflation really is when you see some of these prices that jump around all the time influencing the data. And this is the measure that the Federal Reserve typically uses, core inflation, taking out food and energy prices. Still elevated here, 4.5%, but not quite as high as that 5.3% measure. And then to put this in context, the Federal Reserve is typically targeting inflation for the US economy to be at 2%, and anything above 3% is where we begin to see red flags, where we begin to see some concern that inflation is becoming excessive. So we hear about the term excessive inflation, and that really is inflation that gets over about 3%. So 2% as a target, anything over 3 is typically considered excessive. Again, to put these numbers in perspective. So what's the big deal? Why is inflation such a concern for the US economy at any time? Much less in 2021. So what's really going on? Well, the bottom line is that high inflation simply erodes the purchasing power of consumers. So when the price level goes up, when prices of goods and services that we buy in the store every day go up, then our purchasing power isn't as high. We can't buy as many goods and services with the dollars that we have. So significant inflation is a definite problem for the U.S. economy if it is persistent and significant over time. And so what is likely to happen going forward is that if inflation does remain high, remain significantly above that 3% threshold we talked about, the Federal Reserve will likely step in and raise interest rates relatively sooner, which, as you can see here, would potentially slow the momentum of the recovering U.S. economy. As interest rates rise, that makes the cost of borrowing go up. And so as a result, we typically see less economic activity. And so that's one tool that the Fed has to keep inflation in check. But of course, that's going to have impacts on the housing market as well, making housing less affordable. So interest rates going up, as you all know, directly impacts the housing market. So this is a big deal to be tracking, because in a very real sense, the Fed has to choose between two bad options if we do see inflation persist throughout the second half of 2021. Because one choice is either to let inflation stay relatively high and therefore purchasing power erodes, or they raise interest rates, which could potentially blunt the momentum of our economic recovery, which at this point is still somewhat fragile. So that is why we do not want to see inflation persist, and why we're hoping that it is transitory or temporary. Now, the good news is that most of the data so far do suggest that the inflation that we're seeing now is likely to be temporary or transitory. And there are a number of ways that we can see that. But one way that I want to focus on here is just to look at the contribution to inflation that is resulting from goods that have seen an increase in price this year simply due to a ramp up of demand in the service sector. So some of a majority of the goods that have seen an increase in pricing in 2021 are those that are associated with the service sector. So things like used cars, airline travel, lodging, gas prices. So all of these are items that we would expect to see an increase in, we would anticipate seeing an increase in price levels simply because the demand has come back. We've seen wild swings in demand in 2020. The service sector has come back to life. Demand is very, very high. And so when we see demand rising very quickly, it's normal to see an increase in price. So there's nothing inherently wrong with that. And as demand in the service sector levels out, then we would expect that price levels will level out as well. And so that inflation rate will come back down. So as long as the majority of the items that are contributing to our high rate of inflation can be traced back to this increase in demand in the service sector due to a recovering economy, that suggests that the inflation rate, the high rate of inflation that we're seeing now, is more likely to be temporary. And the way that we can see that in this graph is, I just want to highlight one example. Year over year, used vehicle prices have increased by over 45%, which is just a shocking number when you really think about that for a moment. And that has been the main contribution to inflation that we have seen in this last month. And overall, if we put that in full context, 5.3% inflation for the US economy, about 1.8% of that just came from these used vehicle price increases, which means if we take that out of the equation, inflation would have been at 3.5% instead of 5.3%. Still above that 3% threshold, but much lower than 5.3%. So again, much of this inflation is coming about from the ramp up and the increase in demand for the service sector. And that also begs the question, if inflation is transitory, or we're seeing that it's transitory now, what if it moves to, or what if it's more likely to become permanent? How would we know? And by permanent, I mean more long lasting throughout the second half of 2021 and into 2022. How would we know that's happening? And the answer to that comes from looking at the growth rate in average hourly earnings, looking at the changes in wages. Because when we look at the overall prices in the economy rising, wages, of course, are the price of labor. And when wages go up, they tend to be they tend to go up permanently. So we don't often see wages go up and then come back down significantly. Once employers raise wage levels of employees, they typically stay at that new level. And so if we see broad-based rapid wage growth, then that it suggests that the inflation that we're experiencing may be more likely to be persistent as opposed to temporary or transitory. And so one way to visualize this, here, again, another graph pulled out of the report, is just comparing average hourly earnings and growth in average hourly earnings across all industries versus just the leisure and hospitality sector. And if you look at all industries as a whole, you see that on a month-to-month basis, we're seeing slow and steady wage growth, which is what we want to see, going back to June of 2020. In leisure and hospitality, though, we've seen a major increase in 2021. Again, that's to be expected because we've seen a rapid increase in demand in the service sector. And for the reasons we talked about, it's been a struggle for many employers to get workers to come back. And so one strategy that they've used is to raise wages. And we can see we can see that very explicitly in this graph. And so what I would suggest to you is that going forward, if the picture for all industries, that blue line, looks more like the red line going forward, then that would suggest that inflation is more likely to be long-lasting and less likely to be transitory. But right now, there is no evidence of that. So again, right now, inflation, yes, it's a concern, but it also appears to be transitory, at least according to most of the data to this point. Okay, so just wrapping up then, some concluding comments. What is the bottom line here? Just a couple of concluding points. South Carolina's economy has experienced a strong rebound that we have seen over the last year. We've seen a number of different data sources that illustrate that point. Most sectors are now approaching pre-recession employment levels, and several sectors in South Carolina have fully recovered. So in general, that story is true. The major exception is the leisure and hospitality sector, which we've seen is still down about 13% or so. But even in the service sector, we're seeing a ramp up of demand. The data that we have only go through basically the beginning of the summer, and the initial data since then suggests that there is a very much a pent-up demand for the service sector, and we are seeing rapidly recovering rates of growth in leisure and hospitality. We also want to keep in mind, from a housing perspective, the income and the substitution effects. We've talked about the major drivers for why housing demand has been so high over the last year. The maintaining employment levels for qualified home buyers has been one major factor, but the other two, the income and the substitution effects, have been critical. We've seen more of a shift towards the American consumer spending more on durable goods and housing, less on services, and now we're seeing a reversion back to pre-pandemic norms, which suggests that we're likely to see a pullback in housing demand as well to pre-pandemic norms in addition. So again, nothing like what we've seen in 2008. We're not talking about a major contraction, but we are talking about a moderate pullback to levels that were more consistent with what we saw back in 2018 and 2019. Prices, however, as you see here, likely to remain elevated. We haven't talked much about inventory. That's something we can certainly talk about in the Q&A period. But inventory remaining low will likely keep prices elevated in the second half of 2021. So sales and pricing, very different metrics there that we need to be monitoring. And they are interrelated, of course, but different effects based on these different causal factors. And then finally, long-run inflation, still the biggest potential economic threat to our recovery. And I would suggest that core inflation, greater than 3.0%, as you see here, that's going to be the metric to watch for when the Federal Reserve is more likely to raise interest rates sooner rather than later. If we do see persistent inflation, if that core inflation rate stays above 3%, then the Federal Reserve is likely to take action. Of course, there are other threats as well, the other major one being, of course, the biological threat of the Delta variant. But from an economic perspective, inflation, the biggest threat in the second half of 2021. So overall, we are cautiously optimistic as we move into the second half of the year. Again, our recovery has been strong so far, and we are anticipating continued growth in the second half of the year, and in the housing market, growth as well, but just not as strong in terms of sales activity as what we've seen over the last 12 months. So we do anticipate some pullback.
Thank you so much, Dr. Von Nessen. That update, I think, sheds some very important light on where we stand in South Carolina and where our real estate industry stands. Looking ahead, we've got a couple of future podcast episodes. We'll be talking about one of our favorite recurring topics, flood insurance, and we've got some other exciting programs for you in the weeks ahead. So stay tuned, and we appreciate you tuning in to another edition of the SCR Good Life Podcast.
For past and future episodes, check out the Good Life Podcast at goodlife.screaltors.org. Thanks for tuning in.